Good afternoon. Thank you so much for joining. Welcome to this session on ICG Enterprise Trust. We're joined today by Oliver Gardey, lead manager on the trust since autumn 2019. He leads a team of 5 dedicated investment professionals who manage the trust's investments. ICG Enterprise invests in profitable, cash-generative private companies in Europe and the US. It makes these investments both directly and through other third-party private equity managers. And this enables the portfolio to be relatively diversified, but nevertheless with enough concentration in the top holdings that a sale of one of them at an uplift valuation can have a good impact on the NAV. Before I hand over to Oliver, as I'm sure you've heard before, a small amount of housekeeping. We're going to have about 30 minutes of presentation with 15 minutes for questions at the end. Your microphones are muted. Put your questions to us by clicking on the Q&A at the bottom right-hand corner. I would encourage you, private equity is a relatively complex asset class and certainly different to normal equity investing. So do ask questions and don't be afraid of asking what you might think may be a silly question, because it probably isn't. And I'm sure a lot of other people will probably be sharing your question. So with that, I will hand over to Oliver. Thank you, Oliver.
Thank you, Billy. Hello, everybody, and it's a great opportunity, and I appreciate your time and effort to kind of spend some time to learn more about what we do and learn about a topic I'm particularly passionate about. I've been investing in private equity for over 25 years. As a matter of fact, I started off buying a company out of bankruptcy and turning it around and selling it successfully after 5 years. So I've had the investment experience as well as the operational experience, and I enjoyed it so much that I continued to kind of stay within the sector. And I have to say, I feel very lucky to have to come across this sector and to participate on the rise of private equity, to witness the rise of private equity over the last 20, 30 years. 20, 30 years ago, it was just a niche asset class, which was only the few privileged, sophisticated investors, such as sovereign wealth funds, high net worth individuals, large alternative asset managers had access to. And today, this little niche investment strategy has really grown to an established asset class with exposure to all aspects of the economy. As a matter of fact, today there are more private equity-backed companies in the UK than compared to the companies listed on the UK stock exchanges. A big issue, and which is I want to dedicate some time to in this presentation, is that access to private equity has been notoriously difficult. And our ICG Enterprise Trust's mission is to make this very attractive asset class accessible for all investors and not just to the privileged few. And that's why I have chosen this fairly bombastic title, Democratizing Private Equity, because that's exactly what we're trying to do, is making private equity accessible for all investors. And with that, I would like to kind of go through the agenda quickly, what I'd like to cover today. First of all, I want to give a quick introduction to private equity and why it has become so popular, what is driving performance, but also tackling what are the risks and issues with private equity and how to mitigate them. And then discuss briefly why investing in a listed trust, a private equity trust, makes sense. And then obviously I would like to introduce you to ICG Enterprise Trust, how we position ourselves in the market, how we differentiate ourselves, and most importantly, what is our investment strategy and how do we compare to other listed private equity trusts or other private equity investment strategies. With that, let's go and talk about private equity in general as an asset class. As you see here on the performance, private equity has been an incredibly attractive asset class. And it's become so popular because the returns were just consistently and very strong, and have outperformed the public markets very consistently over the past decades. But not only that, private equity now with over 4,000 private equity companies in the UK alone, the basket of private equity assets is today a better representation of the real economy than many public market indices. And we'll talk about it and we'll give you some data later on. But with 6 trillion assets globally in private equity has become really mainstream and it reflects the real economy. Looking on the right hand of the chart, if you look at the strong returns of private equity, this represents mainly buyout. It does represent buyout, so it's 12% over the other asset classes. What's interesting to see here is how much it has outperformed. So it hasn't outperformed just by a little. It has had quite a demonstrable outperformance. But that outperformance doesn't tell the whole story. And I think what everybody needs to be aware of is the data on the next slide. Here you see the returns from the range of returns and the dispersion of performance between private equity managers by vintage years since 2010. And you'll see here that accessing the best private equity managers is absolutely critical. So if you invest with the top tier managers, you can generate returns around the 15% or above consistently. However, if you end up selecting and accessing the bottom quartile, you haven't gained much, and you're certainly underperforming the public market indices. And so therefore access to the top tier funds is absolutely critical. Going on to the next slide, here you see that private equity has, and some data on why it has become an important and a growing part of the economy. I mentioned before that it's now $6 trillion of assets globally. But I think the other interesting phenomena of what we're seeing in the markets is that the private equity companies are staying private for longer. And there's an increase in the number of private companies over 60% over the last 20 years. Compare that to the listed companies or companies which are listed on the exchanges. There's been a dramatic fall, and it's about 36% has been decreased. And a lot of that has to do with that it is attractive to be in private hands for longer than exposing your company and exposing yourself to short-term profits and the constant pressure to manage quarterly profits. Furthermore, what we're seeing is that private equity is also very much part of particularly attractive sectors. So what you see here on the side is that 42% of the sectors private equity is particularly heavily invested in are most attractive, fast-growing and resilient sectors in the economy, such as TMT, pharma, medical, biotech, and business services. Now, the question is, what drives outperformance and why is it that private equity has performed so well? At the end of the day, to sum it up, it's really the long-term ownership model really drives the outperformance, and the ability to make good company for the managers, the ability to make good companies and turn them into better companies. And how they do that is by have more time, more patience, and more capital to really implement transformational changes, drive strategic change, operational improvements, and also install financial discipline. Furthermore, the typical investment holding of 4 to 7 years allows you not to be forced a seller or a buyer, so you can weather through cycles, and you can prioritize fundamental value creation over short-term profit targets. A third piece of why we see outperformance coming from the private equity is really about alignment of interests. Management remuneration is closely tied to equity value creation. And that's not only true for the management, but it's also true for fund managers. Fund managers are the largest portion of them, significantly portion of their compensation at the end of the day is what comes through what's called a carried interest. And it's effectively the performance fee. And private equity managers only get their performance fee once a company is successfully sold and realized, which is in stark contrast with hedge fund managers or public equity managers who they can start, their performance fees are often on paper profits. So the alignment of making a good company a better company and really create equity value is very much in place. And then lastly, the long lead time to investments obviously also allows teams and the fund managers to do really extensive research and build up expertise in sectors and countries. And that's what we're seeing through, in particular in our portfolio. A lot of the fund managers have a very strong sector expertise developed over the years. Now, I talked about the issues with investing in private equity. And that's, for most investors, there are some fundamental challenges investing in private equity. And I want to highlight some of those key concerns here. And then we can talk about it in the next slide, how one can address these. Access is, let's start off with access. So top tier private equity managers are very popular, as you can imagine. If someone generates consistently 20% IRR and consistently doubles their money, their equity, they can raise large amounts of capital very quickly. And the best funds are incredibly popular. And therefore, you need to be part of the club effectively and have the relationship in order to get the foot into the door. And then the next part is investing in private equity requires a lot of capital. So a minimum commitment per fund is roughly £5 million. And therefore you need, in order, if you want to build up a portfolio with good diversification, you need about 50 to 100 million to really build a diversified private equity portfolio, which for most of us, that's a bit out of reach. And in terms of liquidity, private equity portfolios take a long time to build. That's part of the long issue with a long-term value creation. It takes about 4 to 5 years to make the investments, and then it takes another 4 or 5 years to harvest them. And so it's very difficult from a particular personal investor to kind of weather through this kind of 4 to 5 year period of cash negative, where you're just investing into the funds, into the investments, but you don't see any gains or any realizations until year 8 or year 10. The average when you get your capital back realized is usually after 8 years after you put money into a fund. And lastly, but not leastly, the administrative burden with a private equity portfolio is immense. Those private equity partnerships and fund managers are spread all over the world with many different tax jurisdictions. The cash flow management is very difficult. The legal documentation to qualify to become an investor is cumbersome. And so those are kind of real barriers for most investors to invest in private equity. And what we're trying to do on the listed trust sector is really to address those issues. And having a listed trust equity manager with an open-end fund closure has really allowed to democratize private equity. So listed private equity managers have long-established relationships. They're usually part of the club, part of the private equity fabric for a long time. We've been around since 1981. We've grown up with the industry. We have the relationships. So we do have the access, and we have the database and the data to select the right managers. And there's obviously an adverse selection issue too. The funds where it's easy to get into are usually the funds you don't want to invest in. In terms of capital required, there's access. It's accessible for all types of investors, because you can buy as little for, in our case, for £10, you can buy a share in a listed private equity vehicle, which gives you full exposure to a diversified private equity portfolio. The third part, which is obviously also a big concern for investors in general, is liquidity. And the liquidity of a share, buying a share, is entirely unconnected from the liquidity of underlying portfolio. So you as an investor can really decide when you want to sell out or liquidate your private equity exposure through the listed trust, rather than when the underlying fund managers are providing realizations. And lastly, I think it's pretty obvious that the administrative burden is much easier by just going to your broker and buying a share and participating in the private equity performance, rather than having to go through all the legal documentations, which is something we obviously have a large team and the experience to kind of take care of that administrative burden. Going on to the next slide, just a couple ideas on terms of what actually makes a high-performing listed private equity manager. What are the key criteria? And I like to highlight a couple of those puzzle pieces here. One is, we talked already about access to top-tier managers. The data I showed you is quite compelling, why it's important to be in the top tier, have access to the top tier. But it's also the active portfolio construction is very important, to be able to kind of really construct a portfolio and identify where the interesting opportunities are, and to invest in that, and to avoid the less attractive areas. So active portfolio construction is quite important, rather than just being in a passive indices, because of the long-term nature of those investments. Having a focused investment strategy is applicable for most investment firms. It's very important that you have a very focused investment strategy, and where you can feel comfortable that the returns are consistent and reliable. But I think particularly important in private equity is about managing risk and returns. And we'll talk about that later, because there are some choices one has to make, and one has to understand better what kind of choice you as an investor would like to do, and what kind of areas of private equity you want to invest. And we'll talk about that a little bit later. But for example, an obvious one is, do you rather invest in buyouts, or do you rather invest in venture capital? And there are different options in the listed trust segment. With that, what I like to do is spend some time on introducing Enterprise Trust. How do we position ourselves in the market? How do we differentiate ourselves, and what is our investment strategy, to put things into context? A quick introduction on us. I alluded to it before. We've been incorporated in 1981. We're celebrating our 40th anniversary in June, which is quite exciting. We are the oldest listed private equity trust on the exchange, and we're quite proud of that fact, having weathered through many storms. As an interesting trivia fact, the trust was started with 20 million in 1981 and never raised a single pence since then. And today we have 818 million value in the portfolio. We have grown to become a FTSE 250 company with all the institutional setup around it, and we're managed by ICG, which I will talk about it in a second. And you see, having weathered through many storms over 40 years, we have a strategy which is repeatable and consistent. And you see here on the track record, we have kind of beaten the benchmark, and we have been outperforming the FTSE All-Share on all categories in terms of share price, as well as in terms of NAV growth. Let's talk about ICG and why that is something quite important to us. The ICG relationship is a real differentiator for the trust. ICG is a FTSE 100 alternative asset manager with a very global reach, 400 employees, 14 countries, close to 50 billion assets under management, and over a 30-year track record. As a matter of fact, funny enough, the Enterprise Trust was actually one of the original investors in ICG, and has very much benefited from the rise of ICG over the last 30 years. But why does Enterprise Trust benefit from this affiliation and from this platform? First of all, it's access, and we talked about it before, why access is so important. Having that access to 400 employees, global reach, 22 strategies in 14 countries, that really gives us the access to relationships, fund managers, and then leveraging that gives us really the insight into portfolios, into companies. When we look at companies, when we do our due diligence, it's very rare that ICG has someone in the ICG team hasn't already actually been seeing or studied that sector or that company, or maybe even at some point in time touched the company or done some due diligence on the company before. Deal flow is very important. ICG gives us a great deal flow. 25 to 30% of our portfolio are ICG investments. We really benefit from being able to kind of see the best ideas of ICG and participate. And lastly, but not leastly, it's the support of having the support of a FTSE 100 company gives us a whole nother level of back office, reporting, compliance, finance functions. I'll point out to one thing, which one opportunity or topic which we just announced this year that this week, that we have had a new funding facility put in place, which is much better than we had the existing fund facility. It's been so we managed to actually increase the maturity and get a larger fund facility of 200 million pounds. And as you can imagine, in this current market environment, that was not such an easy feat to do. Considering that banks are actually less keen to do those kind of fund facilities. And so our ability to kind of secure our balance sheet with a very strong balance is really credit to the ICG dedicated credit team and credit facility team who provide us with that support for all of the strategies on the ICG platform. Moving on, I think the next couple slides is really where I'm trying to inform you and get a feel for you in terms of what is our investment strategy and how we position ourselves in the market. At the end of the day, our investment strategy and enterprise trust's goal is really about generating superior risk-adjusted returns. And what do I mean by that? It's about reducing risk as much as possible without sacrificing these stellar private equity returns you can generate if you're with top-tier managers. And so our strategy is very much formed around that. And when you look at this filter slide here, the bars in light gray and light blue shaded are really about how we reduce risk. And then the two dark blue shaded areas is really how we're generating returns. So we're focused on buyouts. We do not do venture. Venture has an incredibly higher loss ratio. It's about 70% loss ratio versus buyouts, or top tier buyouts are 10 to 15%. And venture is a little bit like playing roulette. You put the chips all over the roulette table and you hope that one of them will turn into a Tesla. But that's not the investment. That's not our investment strategy. We're really looking to try to reduce our risk. That's why we invested only in developed markets, Europe and the US, because that's where the deepest market is, where we have the most experienced managers, as well as a very liquid market of buyers and sellers. We only invest in mid-market to larger buyouts. Why? Because those are the buyouts and the firms who have access to a large amount of resources. So they're not just stock pickers. They can actually, post-acquisition, owning the company, put in their resources, their portfolio teams, their capital market experts, their sector experts, to really provide value add to the company to make it a better business. The next two slides is really about how we generate returns. Top tier managers, don't need to talk about that anymore. We've seen the data. The access to that is really what can drive your returns. But then what we try to do is create a balance around, as Billy alluded to earlier on, is invest with the best ideas with those managers. And so what we're trying to do is, with 50% of our portfolio, invest in managers, and the other 50% is invest alongside their best ideas and pick companies, particular companies which have strong defensive growth characteristics. What do we mean? I'll highlight some of those companies later on. But what we mean by that is companies where there is good downside protection because they have subscription-based revenues, like software companies, education businesses, but at the same time where there's significant growth and they're in a growth, so you can generate returns and growth. Moving on to the next slide. Here's what you see is the result of that investment strategy. You see here 92%. It's roughly 60% Europe, 40% US. Our goal and our vision is to get more to 50-50. But what we're particularly proud is with that active portfolio construction and our active search for defensive growth businesses, we managed to build a portfolio with a very resilient portfolio, which has exposure to sectors such as healthcare, TMT, consumer staple, and business services, which are very resilient and not cyclical sectors. And our exposure to cyclical sectors such as industrials, leisure, and financials is fairly small. And that's really a result of the active portfolio construction. Lastly, and this is another very important part of our strategy, is that we look for the right balance between diversification as well as building a portfolio we can proactively construct. So 50% is third-party managers, where we get the diversification, and then we pick selectively from those best ideas and construct that portfolio. So it's about 30 to 50 companies which drive value. 30 companies represent about 50% of our portfolio. And that's very different to some of the fund of funds you see in the listed trust, where you get exposure to 1,000 companies and it's a very passive. You get also good access to top tier managers, but it's a very much more a passive approach. And then you have firms where they are direct vehicles into the buyout funds, where your value generation is really driven by a handful of companies, and therefore you're increasing the single asset risk. So what we're really actively trying to do is to kind of get the best of both worlds. And you see that in terms of, on the next slide, how we do that and how successful it is. So on the right-hand side, you see the third-party funds, which represent about 54% of our portfolio. We like to be somewhere around the 50%. And that underpins the portfolio and the baseline of our portfolio performance. And that has generated 14% IRR over the last 5 years. And then we try to supercharge that performance by picking the best ideas from third parties and from ICG investments. And you see here that of the top 30 companies, 20 companies fall into that sector. And that's where we have been able to generate 19% over the last 5 years. And combine that over the last 5 years, we generated close to 100% NAV per share growth. Another way of looking at is our investment strategy working? Is it repeatable? As you see that we are very focused on being able to repeat and have a sustainable performance. And you see here that we have managed to very consistently get somewhere around the 15% IRR. And to get double-digit growth, we've had 11 consecutive years of double-digit portfolio growth. And what we're particularly proud is that how resilient the portfolio was during 2020, 21. And you see that we have already generated over the last 12 months, 12% growth during a very difficult year. And we're expecting that actually to improve as we've seen very strong Q4 data coming through. Give you some highlights on our portfolio. As I mentioned before, 29% of the portfolio is in the top 10 investments. Close to 50% are the top 30 investments. So that gives you an idea. It's diversified, but those companies, as Billy said, matter. We invested in PetSmart Chewy. You might have heard of this company before. It's the largest pet supply retailer in the US. And Chewy is the largest online retailer, phenomenal company, growing very strongly. Why is this a defensive growth business? Because pet ownership is a remarkable business. As you can imagine, pet owners really care about their pets, and pets have constant needs, not just food. And therefore, pet owners are constant buyers of pet supplies, no matter if you're in a recession or if you're not. And Chewy has been a remarkable success story in the US. It has become now the third largest consumer logistics supplier after Amazon and Walmart, and really have benefited from a growth in pet ownership. The other company I'd like to highlight is Froneri, which is a remarkable story. It started off really as a private label ice cream manufacturer, local UK-based manufacturer of ice cream based in Yorkshire, under the stewardship of PAA Partners. They managed to really build out this business to become a global market leader, and is now the largest global producer of ice cream, with many brands you're familiar with, and strong alignment and alliances and relationships with Nestle's and other multinationals. And as you can imagine, ice cream is a fairly resilient sector, as everybody most people I know like to eat ice cream. So you see here in this kind of, these are our top 10 companies, diversified over sectors and geographies, have a strong defensive growth characteristics. But you also see the benefit of the ICG affiliation. 5 of the top 10 companies are ICG investments. And it's not a sign of, and this is a sign of companies who have grown into that because they didn't start off as being a top 10 company. These are all successful companies because they've grown into becoming a top 10. With that, I'd like to, before we open up for Q&A, I would like to make some concluding remarks. I hope you got a feel for why private equity is a very attractive asset class and why it's become so popular, and that it will remain very attractive because of the superior governance and the long-term active ownership model. However, it is a challenging asset class, and private equity is hard to access. But the listed private equity sector really has managed and is continuing with the drive to democratize the market and give that liquid access to all investors. We at Enterprise Trust are proud that we have now a 40-year track record and a demonstrable value creation to kind of create consistently double-digit growth. And it's really driven by the relationship we have with ICG, the experience we have, having a very focused investment strategy, and that makes our we believe very strongly that makes our track record repeatable and sustainable. I would add one last comment, as I think what is important to realize that obviously that private equity is generates outperformance because it's a long-term value creation, and therefore these investment trusts are not not suitable for active trading strategies. These are investment areas. It's all about investing for the long term. It's a great thing for your savings or your pension, and benefiting from the underlying portfolio growth and the double-digit growth rates you're getting. It's not necessarily a stock or an area or sector which lends itself for active trading. So I hope I was able to give you some kind of a overall introduction to private equity, why is it an attractive asset class, and get a bit of feel for how we're positioning ourselves on the market. And I'd like to thank you for your time and interest, and I pause here and I'll open up for Q&A.
Thank you so much, Oliver. One general question then is, there's also been a lot of capital going into private equity in a broader sense. Has that reduced the return potential of the asset class as a whole, and how do you avoid overpaying?
It's a great question, and I have never experienced a year in my over 25 years of private equity experience where people were concerned about more capital coming into the market and therefore driving returns down. What has happened is actually something very different. What has happened is the overall private equity returns have stayed remarkably stable, and the risk has come out. So you have less outliers and disasters in the last 10 years than you had in the previous 20 years. And I think what you're seeing is that the private equity overall as an asset class has become more mainstream. People are more experienced about how to do this. This is not easy, and know how to do long-term value creation. And therefore, I'm very positive about the outlook. And I do think it will continue to outperform the public market indices because people are just smarter about how to do this. It's going to be, you're going to see less outliers probably, but you're also going to see much less risk and disasters, much fewer. The other thing I would put things into perspective. We're talking about a 6 trillion asset class, which dwarfs the public market indices or the bond markets, which are over hundreds of trillions. So we still have a long way to go. And at 6 trillion in general per country or geography, private equity deals in a given year only represent about 1% of the overall industry and of the market of companies for sale. So it's still, although it's become more mainstream, in comparison to other asset classes, it's still very small.
Thank you. On a slightly related question, but are top tier managers consistently in the top quartile, or do top tier companies change year on year? Is there a lot of persistence in performance?
Yeah, there's a lot of persistence in the performance, and those are the ones who are most difficult to access. Now, there are always some managers who come into the first quartile and then drop out again, and will never come back into the top quartile. So that's where the selection criteria becomes important. We're having the relationships, understanding the managers, understanding the governance, understanding the team, what's going on in the teams is important. But it's a very consistent group of top tier managers who stay there consistently in the top tier.
Great. And then we had a number of questions about ICG as managers, I suppose, and the relationship you have, because obviously ICG is a separate asset management company that invests its own capital as well. So how maybe you could describe how that works, how do you avoid, how do you pick up all of their deals? If you think they're duff deals, are you forced to invest in them? Is there pressure for you to take deals from ICG? Is it more push than pull? There's a sort of number of questions on this subject, which hopefully that's sort of encapsulated.
Yeah, so I see. So we manage the capital for the investment trust, the enterprise trust, which is governed by a separate board, and they supervise us. And we are completely free in our investment decisions of the ICG PLC. And so we have our own independent board, our own investment committee. And so we are not forced to do any of the investments ICG offers. However, and of the 22 investment strategies, to give you an idea, I think we're right now invested only in 3 of the strategies, because we look for private equity type of returns and private equity type of strategies. And most of the ICG strategies don't necessarily fall into that field. And what we try to do is obviously make sure that we do and benefit from the overall institutional expertise and knowledge as well as deal flow. So we do, in the particular with the private equity investment strategies, we reach out and ask for co-investments if we see an interesting deal. Usually, and most of the time, it is something which is a rare jewel in a diamond, which ICG likes to keep for themselves. And so we ask for it, and because of the relationship we have, and we actually get preference, and as well as alongside with other investors in those funds. And so we can participate in those in that deal flow. But it's entirely up to us if we want to do that or not, and we have a separate independent process here.
Fantastic. A few questions on the discount. Obviously, some comments that it's quite persistent in the listed private equity sector. Certainly,
Yep.
There are a couple that aren't, but most are. Any comments on the discount, the persistence of it, and any strategies that ICG?
Yeah. So the discount is something which has been quite persistent, and is something which you can think about it in several ways. Number one is if you buy into something at a discount and you sell it roughly at the same discount, you're still not better or worse off than investing in a stock which doesn't have a discount. So it really, the most important thing is to look at the underlying portfolio growth, because that is eventually what you are investing in. You're investing in an NAV in a portfolio, and if that grows over long term, you will participate in that no matter where the discount is. So if you come in at 15 to 20% discount and you sell out at a 50-20% discount, it's really all about the NAV growth. And that's the most important thing to look at the listed trusts market, is what has been the historical NAV growth and how persistent and consistent that is. Now, what we do think, and where we are doing a concerted effort, and I know the other listed trusts are doing that too, is the market to understand our private equity industry a bit better. And that's part of the reason why I appreciate having the conversation, and Billy and Kepler are allowing us to kind of communicate. We think that private equity is still an investment class, asset class, which is not as well understood. And we as managers have to it's our responsibility to inform our investors and make them understand better how it works, and create more transparency around it. And we do believe that, and I do believe strongly that over the years, the discount should come back. Should reduce. And I think a lot of it, and the third thing is a lot of the discount came also from after the global financial crisis, where investors were a little bit, where some of the trusts didn't work out. It is a fundamental different industry today, much healthier. All the trusts have fund facilities and strong balance sheets, don't use leverage, versus before the financial crisis and during the financial crisis, a couple of them had actually leverage, and there was a lot more risk attached to it. And the sector and the industry is much healthier today, but it hasn't been quite recognized by the market yet.
Thank you. A quick one, which to do with risk and reward. Do you ever invest in loss-making companies?
No, we don't.
Brilliant.
We only invest in companies where we can understand the business model. We understand a company which shows defensive growth characteristics, where we can see positive cash flow and protected in areas of cyclicality, and where we see having a robust business model or market leadership or a brand where the growth we and the investment in the company can benefit from the growth in that sector, or from that, or from a technology or its uniqueness in the competitive positioning.
Thanks, Oliver. One last question from just down the road from me, where I am now, Philip. Do you envisage more opportunities for private equity to effectively delist, deep value small caps that are listed and run them better private? And is that something that you get involved in?
We personally do not get involved in, because it's a very complicated process. And there are some firms which you need the expertise around that. And there are some companies who are excellent in doing that, which we back. But we directly don't do this. It is quite difficult and quite resource intensive. Do I see the opportunity continue? Absolutely. There are a lot of companies which are misunderstood and are hostage to short-term profit thinking, and could benefit from a long-term value creation. I'll leave you with this departing comment. A very good friend of mine from business school runs a division here in the UK of one of the multinationals, and I was cycling with him the other day, and he was complaining to me that in order to do the right thing in his business, he would need to kind of invest in the business, put capital in it, and which would mean the profitability of it for the next 12 to 18 months will be reduced. But he does not have the luxury to do that, because there's constant pressure from the analysts and from his board to improve profits and on a quarterly by quarterly basis. So a lot of things get mismanaged or undermanaged because of that short-term profit orientation for profits.
Well, that's a great note to finish on. As you said, private equity is a long-term investment asset class, and I guess investors should only invest in it if they have a long-term perspective. But also the reasons behind that is clearly highlighted by your bicycling conversation. So if only all our time was as productively spent on a bicycle. Thank you, Oliver, so much. Thank you all for listening. That's all the time we have now for all the time we've got. But thank you. And our last session of our 3-day event will be starting at 2 o'clock in a few minutes. JP Morgan Core Real Assets. So once again, thank you, Oliver. Very kind, and see you soon.
Thank you, everybody. Bye-bye.